Most people overlook the fact that reports made by accountants are not made for accountants to use, which is why understanding financial statements should definitely not be a job for the accountant, but instead for the business person. Whether that business person own a small business or work as an executive for a multinational corporation, that's really irrelevant. Anyone that is involved in business should have a basic understanding of the financials. The idea of looking at a long list of numbers and columns and actually making something useful out of it seems impossible. Often just the thought of rummaging through the numbers is daunting, if not downright scary. The reality is that it's not difficult as it might seem. The purpose of the financial statements is to give the user the ability to understand the current health of the organization, determine a value they place on the organization, and make predictions for decisions. A typical user is an investor. They want to know what the business has available. They want to know how much debt has been incurred. They also want to know what profit has been earned in past years. Another user that is typical in business is a creditor. Think banker. Creditors are trying to determine if the managers that run the business will have the available funds to pay them back. Creditors typically focus on what the business currently owes and how much profit has been made so far. They use this information to make a decision as to whether or not they will lend the business money. Now that you understand what the financial statements are used for, let's consider the financial statements that are used most of the time. First, let's consider the balance sheet. Simply put, the balance sheet shows what stuff the business has and how it got that stuff. The stuff owned by the business is called assets. Assets are resources that the manager or owners that run the business have available to them to run the business. For example, a trucking company has trucks. These trucks represent resources that are available for managers to put to use to make profits. The more trucks, the more potential for making profit. Assets generally include the cash the business has, inventory the business has to sell, supplies used in the business, and the buildings and equipment that are needed to run the business. Those are the main assets, but the type of assets really depend on the type of the business. For example, you might see a lot of inventory for a grocery store business, but a lawn service may not have much inventory. Instead, they'll have a lot of equipment on their books. In addition to understanding what resources the business has, it is also important to know how the business has acquired it. To get the necessary resources, a business either needs to take on debt or use money that was invested. Let's say you want to start your own restaurant. You might save up and invest in the business yourself, but if you don't have enough, you might ask others to invest with you. Another option is to take out debt. The balance sheet gives you an understanding of how much debt was used versus the investment in order to gain the resources necessary to run the business. Next, let's consider the income statement, or also called the profit loss statement. Most business people intuitively understand the importance of determining profitability. The income statement provides the profit of the business for a specific period of time. Usually that period is a month, a quarter, or maybe a year. The income statement's bottom line is known as the net income. It's the profit. It is derived by taking all the revenue earned and subtracting the expenses for that period of time. Now that you understand the balance sheet and income statement, you can begin evaluating the business on your own. Look over the balance sheet and see what kind of assets are there. Are the assets what you expected? If not, you may want to research that aspect of the business. For example, you may want to know why there is so much inventory for an airline. Consider the debt and the equity. How much does the business owe compared to the assets that they have? Think about it. Too much debt may seem risky. Consider the profits of the business. How much profit does the business have this year compared to previous years? Is it increasing or decreasing? What about other businesses in the same industry? This is just a start for analyzing the business, but it's a good start that many people are unable to do. You can now begin to evaluate the business for yourself, and as you get more practice, you can develop more tools to analyze the business on a deeper level.